Let me bring on board Big Market Voice Sunil Subramaniam joining in this afternoon. Sunil, first of all, thanks a lot for joining in. Happy Diwali to you, and wish you lots of wealth, good health, and prosperity. And everybody, I've been telling everyone that peace of mind is of utmost importance. So I hope you have a lot of peace of mind as well in Samvat 2082.
Thank you, and I reciprocate the same to you and to all the viewers. A very happy Diwali and a very prosperous Samvaat 2082 for all of you.
Thank you, Sunil. Lovely, and it's always lovely to be interacting with you. Good thing is that the bulls got into the festive mode just at the right time, right? 2 weeks we've seen the Nifty gaining in excess of 1200, 1300 points. We are back near the 26,000 mark. So although returns have been in single digits for the Nifty for Samvat 2081, what are the chances that equity as an asset class could make a comeback in Samvat 2082? Because this time, of course, it has been gold, hands down, gold, silver. Do you think we could take back those reins from precious metals in the coming Samvat? What are your thoughts?
I think, yeah, there'll be more even spread. I think precious metals will still give decent double-digit returns, but equities should make a strong comeback. And I think the reason for that is that, as you said, in this Samvat, we have just seen a 4% return for the Nifty as of now I was seeing, and the small cap index has been in fact minus 4%, with mid cap a little bit on the positive side. So clearly this has not been a great year for equities. And if you analyze the reasons, right, it's clearly the FII selling, right? And the FII selling on the backdrop of geopolitical and geoeconomic tensions, right? Both combined put together has also led to a re-rating of India from a valuation perspective, and which is where I think that the last year was disappointing from the perspective of FII investment for us. But from an FII perspective, they made the right call because Chinese market has delivered 50% almost returns year to date. So clearly where they've pulled out money from India and put it there, I think the returns have justified that. But for the very same reason, with a 50% rally there versus a 4% rally here, I think the valuation difference has got reset a bit. So I'm optimistic about the new Samvat that equities will gain back the strength, of course, on the back of the return of the FII.
Yes, and we've already started seeing the signs, right? Sell-off has abated. We've seen, meager amounts, but still small amounts. FII have started coming back in, buying in cash markets, short covering as well, going on. But of course, once FII's return, would you expect IT to be the first pocket to fire up? Because numbers haven't been all that bad. We were working with subdued expectations, but most of them have delivered. And what with all the AI investments that have been announced, some companies have started declaring AI revenues. Could AI for us as well turn out to be a big theme in the coming Samvat? And if FPIs come back in a big way, will IT be the first to fire up, since banks have already started firing up?
Yes, absolutely. And the reason for that is the correction that's happened. So the margin of safety in IT has increased now, right? I think 1 year it's what, 17-18% down compared to a 4% plus for the Sensex. So you're actually talking about a 21% underperformance. And as you said, the numbers are decent. The issue there, I would say, is that the companies are not talking very optimistically. And that's why the markets have not reacted positively to the numbers. But that's because I think the mood internationally in terms of the US, because of the tariffs, is still uncertain, right? But I think that that's a temporary phase, and soon the market will start respecting that. And one key thing here, Nandita, which I may say is, while FIs have been broad-based selling across the index, right? What DIs have been buying has decided what has given return and what has not. So the DIs have been buying banks. So it's not that FIs have not been selling the banks. The FIs have been selling fairly across the board, but DIs have stepped in strongly into the banking, especially the PSU banking space, and that's why the rally. So they have not bought IT. So what I'm trying to say is the step one is for the FIs to return. There will be broad-based buying where IT will also feature. Because it's fallen so much, it will bounce. And then because of that, DIs will then step in as the mood gets better. And the trigger for FIs to come back, remember, has to be some sort of a solution in the tariff front. At least an interim tariff deal between India and the US will be important for that. Otherwise, these trickles will probably remain trickles. I think the heavy selling pressure is off because the valuation differences have narrowed significantly between China and India. But for FIs to come back in a big way, I think there has to be some positive news on the tariff front. If not a full-fledged deal, at least an interim deal where the easy wins are taken, and then they say that they'll continue talking on the tougher parts like dairy and agriculture and oil with Russia and all of those. So I think that's got to be a key for the new Samvat, and I'm confident that in the space of the next 1 year, it will get sorted out in some form. And so your portfolio should actually contain a component that what if the FII returns in a decent way, that should be the ones which should form a significant part of your portfolio, because that's been the gap in the last year, and I don't think that will be a gap for one more year to come.
Got your point. But talking about the banking sector as well, since we touched upon it briefly, FPIs are still underweight, and global banks, of course, are now looking to invest in names like RBL and Yes Bank as well. But are we entering a new foreign capital cycle for this particular sector? We also have Federal Bank considering fundraise later on this month. They have, of
Absolutely.
course, not said that there is some private equity giant is interested, but of course, we'll come to know in due course of time. Could this be a new foreign capital cycle for the sector, and could that also dominate the themes, overarching themes, so to say, for Samvat 2082?
I think so. And the fact is, what you didn't mention is also the public sector banks. I think there are strong signals coming for government of next round of mergers
Yeah.
to make banks globally competent and globally competitive. And when that comes, and there also talk of, remember, raising the FII limit in public sector banks up to from 20% upwards. So I think that, yes, I think foreign interest in the Indian banking sector, because I think the Indian banking sector has shown resilience right from the COVID phase where there was restructuring of loans to the post phase. I think asset quality has been fairly robust and strong. And India's penetration from a lending to GDP perspective, we are still behind the advanced countries, right? So we are at about 57, I think, percent or something like that. And advanced countries are at about 65, 70% easily. And so I think the scope for lending to grow. And the key element here is that consumption. The government which has woken up to the fact that the middle class as a consumption sector is the one which had suffered post COVID. And now they're putting all their energies behind this with the rate cuts in income tax, RBI rate cuts, as well as the GST cut. Consumption is essentially financed by borrowing, whether it's through credit cards or through EMI based auto loans or personal loans or whatever. And RBI is doing its bit to help that, raising the lending limit against shares to 1 crore. So I think that one, the retail lending aspect, individual lending, if I may call that, is also set. And gold prices rising are helping because gold financing companies have now that much more room with a higher gold price to lend based on the stocks on hand. So, and then the second leg of the cycle, Nandita, I want to point out is that what I see that the consumption cycle is ultimately going to lead to better capacity utilization and the start of a capex cycle. And a capex cycle is not seasonal. It lasts for about 3 to 5 years for the entire capacity expansion to go through. While I still believe there is some way to go, maybe 6, 9 months more for the private sector capex. But when that starts, it's, mind you, it's not just the stock market companies, it's the SMEs and the MSMEs which will be going to be executing those expansion orders. And there, the lending by the public sector banks, is the key, because public sector banks are the ones who have an experience, multi-decadal experience in lending to the MSME and the SME sector. And these loans are at fairly good yields. 13 to 14%. So you'll see public sector banks, not only their loan book growing, their net interest margins also will be positive. So overall, I see that's a good space. And since we are talking BFSI, let's not forget the non-lending side of the BFSI space, right? You have the stock market infrastructure companies, the wealth managers, the asset management companies, the insurance companies. With all this income tax benefits and everything flowing through, definitely we are in a stage where the per capita disposable surplus, whether that's saved or spent, is the question in front of the customer. But definitely from the savings part of it, I think the banking system as a whole, when I take the overall wider system, is poised to grab that share of the individual's money. And so I think the entire BFSI space is poised. Yes, last year it has been the top performing, it has done well. So obviously for next year to repeat itself will be a challenge because your base is larger. But still, there's no, as far as I see, not too much negatives around the sector. Is by and large a positive story. So FIIs, FDI is already coming into banking. FIIs as you said, they are underweight still this year. So next year, if that corrects, you can see a fresh leg up for the entire BFSI space.
Right. We discussed a lot of things already. Even in our previous interviews. But I want you to list out three themes in a pecking order that would be your favorite themes for the next Samvat, say 1 year.
So when you have 1 year in mind, for me, it's okay.
Hmm.
One section of the consumer durable will come to play in summer.
Hmm.
That's the whole cooling segment. So air conditioners, refrigerators,
Hmm.
water coolers, those. So that leg of the rally is not, it's not the key part now, because people buy that only in the summer, right? So I think there's a one consumer durable
Hmm.
play, and I'm going by the fact that the last 1 year returns for the consumer durable index have been negative despite all this festival season and
Hmm.
all that growth. Overall, Nifty Consumer Durable Index is still down -4%. So there is enough catch up space there. And so I think halfway through next year, during the summer, you'll see a strong leg up rally happening in that portion of the consumer durables, which I think is then a good pick from that point of view. The next sector, also related to consumption in a way, is real estate. And in real estate, why I'm positive for this
Hmm.
Samvat is because after this auto related and television related rally, which is dominating the summer, the festival says, and the next is the consumer durable, the
Hmm.
cement prices have also got GST easing, real estate as a sector. But
Hmm.
the real estate sector is also one of the most underperforming sector for the last 1 year. So the margin of safety is there.
Yeah.
But second point is that the problem there, see, in the case of consumer durables and auto, right, it was a case of demand not keeping up with the supply. There was adequate supply, enough car manufacturers, enough durable manufacturers, enough there in the marketplace. But in real estate, all the developers, right, all the bigger ones and all, have been
Hmm.
focusing on the very high end of the luxury real estate, the villas and the penthouses and the big, and those are the ones who are selling. So nobody has prepared for the affordable housing segment yet in a big way, and because the demand wasn't there. But now, with the concerted effort of the banking system as well as the GST cuts happening, I think that you will start now. The supply will step up in terms of real estate developers launching affordable housing projects. They need to tie up the land and launch, and then so they'll take a bit of time.
Hmm.
But when that happens, because the maximum impact of an EMI cut is the leverage, right? Is will be seen in the real estate because these loans are 15, 20 years. So small drop in EMI can enable you to buy a much bigger house, right? So I think that, or at least buy a house
Hmm.
which you were not planning to earlier. So I think that the real estate sector is the one I believe that, given the past underperformance, given the positive impact of GST and of the rate cuts from RBI which will flow through, is probably to me geared from a domestic perspective to be an outperformer. So that's my second pick for the from a 1 year, the next somewhat perspective. The third pick is
Hmm.
purely the Contra IT pick, because I believe it's a matter of time before FIs
Hmm.
return, before there is some kind of a resolution on the trade side. I don't think we are going to see one more year of this whole trade uncertainty with America, as far as India is concerned, continue. So, with that belief in mind,
Hmm.
the point is I don't know when it's going to happen. So, there is a bit of a risk there that we could go a bit further down before it goes up. But from a 1 year outlook perspective, I believe that IT as a contra bet continues to be in play. And my next, the other pick is something which I
Hmm.
already mentioned. I think public sector banks, they are the ones, despite the rally that's
Yeah.
happened, I think there's enough scope, because I said mergers, increasing the FIR limit in public sector banks, and the business
Yeah.
growth coming from capex revival make a very strong case for public sector banks also, in my opinion.
All right, there was four top investment themes by Sunil. But Sunil, let's discuss what's been happening in the precious metals universe as well. A lot of people or investors are driven by the feeling of FOMO. We've seen or we've been in uncharted territories as well. But of course, heading into Samvat 2082, some bit of correction has been seen. But there's been a lot of debate as to whether investors should increase their allocation to gold in their portfolios. Do you think it's just a FOMO-driven feeling, and one should not look at unnecessarily increasing their gold allocation because much of these factors that have driven this rally, some experts argue, may not be fundamentally driven as such. It's only about what's happening in the US, the geopolitical threat, etc., even the tariff related stuff. So, how are you looking at it, and what advice would you give to those investors who would rush to just increase their allocation to their portfolios?
So I think that first of all, the industry has to take responsibility. When I talk about the industry, I'm talking about the equity market infrastructure industry, whether it's wealth managers or it's fund managers or whatever in the overall stream, that we have beaten down gold historically. We've always said gold is a non-earning, non-productive asset class. It's only a safety pick, so it will not outperform. Equity is your real wealth creator. So allocate to equity, and you have downplayed gold. And today we have egg on the faces. That's, let's openly admit it, right? You have egg on your face because you have not allowed gold to be a part of a customer's portfolio as a diversification. And what's happened is that when you say that it's not fundamental, I disagree, because we tend to talk about fundamental from a sector's earnings perspective, because the market is geared to discounting future cash flows to arrive at the intrinsic value of a share, right? Or a sector or a stock. In the case of gold, right? What is the fundamental factor that you have to look at? Because there is no earnings, right? That's what I think 17 or 18% of gold is to actual industrial usage, right? So 80% of it is not industrial usage. So you can't do your traditional fundamental. But when you say fundamental, there's a macroeconomic fundamental which you have to consider. And what's changed there? I think that's where, again, as I say, the fund management and the overall wealth management space has to take responsibility. What's changed there is the recognition that, I mean, it's kickstarted with, I mean, it ended with Mr. Trump's coming to power and putting that. But even well before that, right, there is the increasing concern around the sovereign wealth funds and the countries of the world of an over dependence on America. And America's fiscal deficit has been ballooning, their debt has been ballooning, there have been warning signs, but American stock market has been exploding. So today you have a situation where 30% of the world's economy is in America, but 65 to 70% of the stock market. So the increasing worry about the rest of the world which had surpluses, Japan, China, about their overexposure to America. I think that's the fundamental feature, that worry. And that's why China and Japan, among leading countries, have started shifting their allocation away from the dollar. Now, their first move there was, in, especially for China and Russia, then before the Russia-Ukraine war itself, was to see whether a BRICS currency could form an alternative. But that didn't take off because China and India had problems with Galwan and all of that, and Russia went to war with Ukraine. So BRICS as a currency never took off. And Mr. Trump came, he further said, if you do that, I'll be very harsh on you all and all that. So the de-dollarization, that is the right desire to move, and Russia-Ukraine war led to a freezing of Russia's dollar balances. So that gave a sharp lesson that if at all you take panga with America, then whatever you invested in dollar is going to be at risk. So there's a fundamental change in the perception of people that earlier dollar was considered the reserve currency, the safest currency that you could blindly put, that US would never come and put a hold on your thing. You could take it out, put it back, all that convertibility, everything is there. But this lack of slowly dimming confidence, and you can't do that overnight. So China and Japan especially have been shifting their reserves for want of any other options into gold, because that's the one which is solid, which is limited, and hence there is a value to it. And that is the fundamental move which has happened. Last year's move was actually a second order move, not by the sovereign wealth funds. It's because individual investors in the developed nations started seeing this and started pouring money into gold ETFs worldwide. So now it's become a philosophy that not only the sovereign wealth funds, but individual HNI investors across the developed nations are pouring money into gold ETFs. And this fundamental change, that the world is looking for a new equilibrium on how much dependence on the dollar as the place to park my surpluses. Japan is an export surplus, trade surplus country, right? China is a trade surplus. So that is the fundamental change which has happened. And hence, I'm today of the view that you must increase your allocation to gold from what you historically recommended as a wealth management, fund management, in stock market related thing, right? So historically, even I used to say 5 to 10%. I'm now saying that you should make that 10 to 20% in recognition of this new reality. See, it's not about India buying gold for jewelry or for festival, for marriage. We have always been among the largest buyers of gold. We haven't changed. We are a base effect. We are always there as a buyer. But the delta that's being created is this international demand for gold, which is one of the factors which is the cause of the fundamental change in the position of gold. And silver is benefiting by the spillover because gold has risen so much that people feel that, oh, there is a risk. Margin of safety has dropped dramatically for gold because of the rise. So back to silver. And silver is aided by a shortage of silver as an ore, and second,
Yeah.
higher 55-60% usage in industrial. So where I'm coming from is that this is the new reality. And you have to recognize. Now, obviously, what is the new thing? My suggestion is that from a 5 to 10%, you have to change this to 10 to 20%. Because gold still remains a diversifier. It is not the primary wealth creator. And tomorrow, if tariffs gets resolved and suddenly Mr. Trump has a new nirvana moment, enlightenment, and says, oh, no, I'll become friends with the world and we'll do, then obviously gold will correct. So there's always, but the fact of the matter is also fundamentally, one more thing, you mentioned this, Nandita, that's the FOMO. So now when you're talking to an investor and you say,
Yeah.
no, you're old. See, one definition of insanity is that when everything else is changing, you keep saying the same thing, right? So why I'm saying this is that we have to recognize that customers have seen that as an advisory industry, we have not advised right because we didn't have a fortune teller thing about the future. But they feel that, oh, if only I put my money in gold. So FOMO is also a fundamental fact of an investor's appetite, which you must recognize. That is also fundamental. So to me, you can probably now shift the allocation of gold to 15 or even 20% based on your risk taking capability. And silver is in addition to that, according to me, half of your allocation to gold you can put into silver. So you're then talking that for a very aggressive oriented investor, you could actually have 30% in precious metals or between gold and silver, right? But of course, your risk and your other appetite and everything to take, considering that something is all run up fast. But I think that yes, a fundamental resetting of the way we look at gold because of the geopolitical and the geoeconomic. Remember, the tariff has a big issue to play with this because tariff is a war, just like a physical war on the ground. This is the new reality. And Mr. Trump has still another 2.5 years to go. Right? You know that uncertainty is going to be, Mr. Trump's another word is uncertainty, right? So to me, there is a huge TERP. I have coined this called TERP. I don't know that I mentioned it in the last time. The Trump uncertainty risk premium is something that the world
Okay.
has to pay. And that is where that is
We had
playing out
taco
in.
earlier, now we have turf as well.
So I'm just saying is that the gold is the safest way not to make Mr. Trump angry. Like if you openly go and say now, oh, I'll not deal with the US dollar, I'll do a BRICS currency, he's going to get angry and do something even unpredictable and in four quoted little words. But gold is, if you're putting your money in gold, he's not going to come and say, I'll punish you, I'll put a tariff on you on gold. And one of the underlying factors which we have to analyze, which is a big if, Anita, is if the US chooses to revalue their gold reserves as a paper method of solving their problems. It's not a genuine method. A revaluation is always considered an intangible. But Mr. Trump forced to the brink. There are still talks about it that the huge gold reserves he could revalue it in order to, on a paper surface, to show the US fiscal deficit coming down, which could lead then to even greater, so but now that's an uncertain thing. I'm not sure Mr. Trump's going to do it, but I hear news and talks, people already discussing the what if scenarios of that. Because so, given all of this in mind, I think that history has taught us, the markets in their history have taught us a lesson that you ignore any asset class at your own peril. That's where the whole world, the key of diversification, that you maintain everything. And historically, you say now that gold was a contra to equity. In the US, it's not proved to be so. Gold has been rallying, equities in the US also has been rallying. So these fundamental rules.
Exactly, in tandem with equities.
So I think it's just the recognition. So in fundamentals, you have to give a value to the macroeconomic situation as it's developing. Obviously, gold can correct for phases, but I think the fundamental reality of the world is that gold is now an important investing asset class for sovereign wealth funds, for HNIs, and so for broader investors also. Better they recognize it and have it. And that's where the mutual fund industry, if I may say, has a reasonably good product called the multi asset allocation fund, which allows you. And based on if you want equity taxation and you want to keep 65% in equities, then you're limited to about 20% in gold. But if you choose to really manage your multi-asset allocation as a open, saying I can do how much gold as you want, a fund manager taking that call, I think multi-asset allocation fund should be a critical part of customers' portfolio, because then you are letting the fund manager take a call on that, as opposed to your saying how much of gold I put in my portfolio. You diversify across maybe three multi-asset allocation funds, which have fundamentally different approaches, so that then you're playing gold with an experienced hand at that job, right? Rather than you're going and choosing, saying X percentage I'll put in gold ETFs,
Sure.
because multi-asset also are more tax
Sure.
efficient than ETFs. So it's also a more a better way of buying gold through a multi-asset allocation fund than to go and buy it directly through an ETF.
Sure.
Tax for tax, it's a little more benefit.
Okay. All right, that's great advice. Buying or investing in gold via multi-asset allocation strategy rather than just going and buying gold ETF. But last question really, Sunil, as we wrap up, for somewhat 2081, so to say. What's that one biggest mistake investors made in somewhat 2081 that they should avoid repeating? What would that really be?
One mistake that investors made in Samwat 81, I mean, uh, ignoring gold, if at all, right, is one. But they've caught up now.
Okay.
Last month, September, you saw that ETF, gold ETF had a 4x multiplier. I think from 2,000 crores, it went to 8,000 crores net flows. So clearly, they themselves felt that they had made a mistake of not allocating to gold. But then remaining within the equities space, right? I would say that. Uh, I would just call it as lack of proper diversification. I think they chase a lot of sectoral NFOs. They'll chase a lot of mid and small cap, sorry, SME exchange IPOs, right? In the king. I think those were the funds. I was the IPO index has delivered -5% for the somewhat, right? So clearly, I think that
Yeah,
they have
yeah.
been going by a flavor of the thing, right? So I think to that extent, when you once you go into the flavor and you over allocate it, you're losing, you're giving, you're saying no to the basic principles of diversification and asset allocation to meet financial goals. So I think that they probably got a bit, I would say, astray, because they saw the fabulous returns of certain sectors. Hence, every sectoral related
Yeah.
NFO that came, they went and put their money, right? So I think probably forgetting the basics of goal planning, asset allocation, and diversification, which are the hallmark of good investing. I think this year they probably got tempted into a flavor of the season, or this that I think that temptation, if they had avoided and they had stayed diversified in a true sense of the word, right? I think they would have been better off. I think that's
Sure.
the key thing. That when the markets go through these kind of period, people tend to forget their basics of investing. I think that's the lesson I would say that that stay diversified at all times. You know which sector, which stock, which asset class is going to come to your aid. Because at the beginning of the year, nobody predicted what happened during this year, right? So diversification is something that you have to keep following. Don't get worried about. For example, I feel that if you look at it, maybe they are underallocated to IT because of what's happening. But who knows, next year IT is the best performing,
Yeah.
then last year is the best time to have invested in IT, right? So I'm just saying, it's just from a principle of not to say that, oh, IT, they should have gone, but as a part of a diversified pool, if IT also would have been in a part of their allocation, right? That would have been, that's the best from the next year perspective. So I would say just that one word: proper diversification based on choosing the right asset allocation based on a financial goal, that the purpose of the equity market is to deliver your future needs, right? Your future wealth creation and
Sure.
aspirational needs. So just the one word I want to say at the end is that ask the people should look at investment as nothing but a postponement of their consumption. And so you want to buy a better thing tomorrow.
All right, that's very
Instead.
well put. Very well put, Sunil. Well, with that, we are out of time. Sunil, would like to thank you for all your valuable advice, and I enjoyed, having so many conversations with you. Always gain a new perspective, and I look forward to more of these conversations in summer 2082 as well. And let's see whether equities play catch up or not in the new summer. But wishing you all the very best for the upcoming Samvaat. We have Mura trading tomorrow, and hope that your portfolio remains firmly in the green in Samvat 2082 as well.
Thank you, Nanda, and the same for all the viewers. I do hope their portfolio also remains in the green.
Thank you. Thanks a lot.